Why does the S&P 500, supposedly a safe harbor for millions, end up putting roughly 40% of its weight into just 10 tech stocks? The truth isn't AI is smart. The truth is a dangerous game. Money moving from the left pocket to the right to make the numbers look better. And if that loop snaps, the shock won't hit someday. It will hit the things you own first. Stay to the end, because I'm going to connect three pieces: trillion-dollar bets, lawsuit risk, and the index fund trap to show why this AI boom could be worse than anything we've seen. Picture a man named Sam, the CEO of the world's most powerful AI company. Sam stares at the balance sheet and sees a cold fact. They burn billions a year to keep the lights on. And when the market starts to doubt, Sam can't slow down. Sam has to press the gas. Because if they're losing money while the hype is still high, what happens when the hype fades? That's bubble psychology. The more afraid you are, the faster you run. And that's exactly what the AI world has felt like. An endless conveyor belt of glamour, new versions, new features, non-stop revolution promises. But users are waking up. Most products feel similar. Many breakthroughs are old wine in a new bottle. Meanwhile, the cost of staying in the game swells like a balloon in the heat, waiting for the pop. A wave of analysis describes OpenAI as a center of the CapEx storm. It's not just buy GPUs anymore. It's national-scale infrastructure commitments. Data centers measured in gigawatts, massive cloud contracts, and custom chip numbers so large that you swallow hard. Some reports claim total commitments could reach over $1 trillion within a few years. The simplest question becomes the scariest. How much revenue lets you sign that? In a bubble, people don't answer with cash flow. They answer with a story. We'll be so big we can't fail. Or more honestly, if we're big enough, the system will have to save us. You've heard too big to fail. In 2008, some institutions weren't allowed to collapse because they would take the system with them. Now shift the context. AI gets tied to national security, the tech race, future productivity. If AI CapEx becomes a growth engine, letting it break can be framed as shooting yourself in the foot. That's why the idea of a government backstop begins to emerge as a viable option. Here, the bubble isn't just valuation, it's politics, strategy, and crowd psychology. And once something becomes not allowed to lose, your risk, taxpayer risk, index fund risk gets pulled in. Now connect the second piece, circular financing. Think IOU at $1 trillion scale. The story goes like this. One party invests in OpenAI. OpenAI signs enormous cloud deals with company A and company B. A and B then use that demand to buy GPUs from the same ecosystem. Revenues rise on paper, stock prices rise, and the loop encourages more spending. Money goes in a circle, everyone reports growth, the market applauds, valuations inflate. But notice the missing piece. If most demand comes from inside the loop, where is the end customer? Who actually pays real money to consume the final product? Some analysts argue that parts of this spending are funded through private credit, SPVs, and joint venture vehicles that can push debt and obligations out of plain sight for the average investor. Everything looks fine. Markets rise or trust. But if that strength is built on borrowed money and circular flows, one slowdown can make the whole chain shake. If tomorrow one company in the loop cuts CapEx by 30%, who feels it first? GPS, cloud, then earnings expectations, then stock prices. And when stock prices fall, the loop stock up to easy funding to more spending reverses into stock down to funding tight to spending cuts. Bubbles don't burst from one cause. They burst when feedback loops flip. And many AI commitments don't hit the balance sheet the way you think. They can sit in long-term contracts, project finance, SPVs, or off to the side obligations. On the surface, a company can look light on debt while the real payments are scheduled in the future. When rates stay high or revenue disappoints, the future becomes a trap. Now the third piece, index funds. The S&P 500 is market cap weighted. The bigger a company gets and the more its stock rises, the larger its weight becomes, and the more passive money automatically buys it. So when you put $100 into an index fund, a large slice flows into a tiny top group, and that group overlaps with the center of the AI CapEx machine, chips, cloud platforms. In other words, AI isn't just a Silicon Valley story anymore, it's a retirement fund story. It's I bought the index because it felt safe. If the market is pricing I like a machine that will generate $2 trillion a year in revenue, the risk isn't whether AI is cool. The risk is whether expectations are far ahead of reality. If expectations reset, prices reset, and index funds reset with you. Then there's the unglamorous stuff, flashy launches that flop, pilots that get canceled, layoffs even while companies chant revolution. Add a rising wave of copyright lawsuits from newsrooms, authors, and musicians. Why does copyright matter? Because it hits AI's fuel, data. If data access gets restricted, costs rise. If costs rise, margins get squeezed. And the story of infinite growth loses a leg. Users also worry, who owns my prompt? Where do my uploaded files go? When trust erodes, adoption slows. And in a money-burning system, a little slower can spark panic. You might even see hints in other markets. Sometimes Bitcoin falls while mega cap tech still looks fine. One explanation is mechanical. Key levels break, rules trigger selling. Another is macro, liquidity tightens, and the easiest risk asset gets sold first. It's not a perfect signal, but it's a reminder that risk pricing can shift before headlines do. Watch credit spreads, layoffs, and CapEx guidance. Those are usually the first cracks, long before a CEO admits anything on stage, quietly. So why is the AI bubble worse than you think? Not because AI is useless, but because four forces stack at once. 1. Massive revenue expectations to justify valuation. 2. Accelerating infrastructure spending, often tied to debt and complex financing. 3. A revenue loop is money circulating among a small group of companies. 4. Passive index flows automatically pump the biggest winners. Together, that's not just high prices, it's an amplification machine. If everything goes well, great. But if one link breaks, the question isn't, does one company fall? It's, how fast does the whole loop reverse? I'm not telling you to sell everything, and I'm not saying AI dies. .com history shows that bubbles can pop, while the technology itself survives. The danger is that at peak hype, everything is priced as if winning is guaranteed. So here are 3 practical moves you can make today to protect your wealth. First, open your portfolio and look closely at what you actually own. Don't get hypnotized by the word safe on an index label. Second, trust real cash flow. Study the cash businesses truly generate, their debt, and the hidden obligations sitting behind glossy reports. Third, never fall for "this time is different." Ask the only question that matters. Who is the end customer, and how much money are they really paying out of pocket? That's the truth that keeps money durable. Hit the like button and subscribe so you don't miss the next AI.